How's it going, everyone? In this video, I'm going to be taking a look at the current conflict between Russia and Ukraine and how that actually affects the market. Now, let's put it out there. The current conflict that's happening in Europe is an absolute terrible thing under any circumstance. Now, any loss of civilian life through absolutely no fault of their own is an absolute travesty, and I really hope that this conflict can be brought to an end as peacefully and as soon as possible. In this video, I want to take a look at how the market is affected by past conflicts, and should you sell your portfolio, should you be holding on, or should you be purchasing more. Now, this is not to make light of the current situation, and this is more just to provide an economic and educational point of view to see how the financial market tend to respond to this particular situation. And some of the results may surprise you. Let's take a look at this chart, which shows the result by LPL Research, and it listed the major geopolitical events over the past 80 years and the reactions from the stock market and how the market reacts to these particular events. So there's around 20 or so major events that happened within the past 80 years. Some are potentially more serious than the others, but that's a whole load of different major political events. Now, if we look at the S&P 500 index, we can see that generally on the event day of these events, the market have significantly decreased within the day. But on average, if we average across all of these events, the total decline for the one day where the event happened is 1.2%, which is not as high as you may expect for a lot of these major events. Now, the total decrease of the S&P 500 index after these events have happened, the total downturn on average across all of these events is around 5%. On average, these events cause the S&P 500 index to drop around 5%. Now, this ranges from a low of some of the smaller events, which only had a 0.3% drop, to the largest one. We have the Pearl Harbor event, which the market were down by around 20%. Next, we can look at the number of calendar days for the index to reach its bottom. So on average, the number of days for the index to reach its bottom is around 22 days, which, if you think about it, isn't actually not that long of a time. So it doesn't actually take that long for the market to reach its bottom after some of these quite significant events. And the longest one that it took was, again, the Pearl Harbor event. And some of the shortest one only lasted a day or even within a week. The next thing to look at is the recovery and how long it took for the market to reach its previous highs. So on average, the market took around 47 days for it to recover back to its previous heights. And again, that doesn't seem like such a long time. And with the longest one being, again, the Pearl Harbor one, which took a little bit more than 300 days, which is about a year or so. But when you think about that again, it's not even that long, considering the major financial crisis that we had in 2008. It took significantly longer for the market to reach its high again, and it certainly took longer than 300 days. For researchers back in 2015, they have also found that in a situation where there is a phase pre-conflict, if there was a high likelihood of the conflict actually happening, the market tends to drop. Now, this is not really something that's that surprising, but when the conflict actually occurs, the stock price is actually increased. But when there is a surprise outbreak in conflict, the stock prices tend to decrease. And then they call this phenomenon the war puzzle, because they're not entirely sure why the market significantly increased after the actual announcement of the conflict. This is kind of like the exact reverse of the situation when a lot of times in financial market people say that you want to buy the rumor and sell the dip. So a lot of times when a company has rumors that they're releasing a new product, a lot of people tend to buy the rumor that a new product will be created and it will change people's lives and everything. And once they actually release the product itself, a lot of people actually tend to sell the company shares and bank a profit around them. So this war puzzle is pretty much the exact opposite of that situation. If we take a look at what is actually happening during times of the actual conflict, and this research looked at the actual market performances during those periods of time. So for the entire stock market for the past 80, 90 years, the average return for, let's say, just look at the large cap stocks, the average return is around 10%, and there was around a 19% in terms of volatility. Now, during the conflict, the return is actually around 11.4%, which is actually a little bit higher than your average return when it's just averaging over all the years. And the risk for these all large cap stocks is actually lower than during normal years. If we take a look at what could arguably be the biggest conflict that humankind has ever had, the return during those period of time for large cap stocks is actually around 17%, and this is significantly more than the returns from normal years. And again, the risk is around 14%, which is significantly less than the risk and volatility on average years. And a lot of it is pretty similar for the other conflicts that has happened in the past. So this is quite an interesting results that may not exactly be what a lot of people were expecting. Now, if we were to tell by the historic data, overall the market tend to not really pay any attention to any of these conflicts, whether it be conflicts in the Middle East or pretty much anywhere else. And the market tend to recover in a relatively short period of time. Now, it's usually within the build-up phase before the conflict actually occurs, when there's a huge amount of uncertainty of what is going to happen, and this is exactly the time when the market usually drops. Within the last trading day, you can tell that the trading algorithm was having an absolute field day with what's going on at the moment. If we take a look at Tesla, which of course is one of the most widely traded stocks, and if we can go down to the hourly charts, we can see that Tesla opened the day at exactly $700 per share, and since then the price has just completely gone up, and until it reached a high of $800 per share. During the entire day, the share price did not go even a single cent below $700. This just means that there's algorithms that's basically just scooping up shares whenever people are trying to sell for less than $700, and it pretty much hit a cap around the $800 mark. So there is a ton of algorithmic trading that's been happening within the past day. So what should you do in this current situation? Now, I know this is quite scary and uncertain times, and a lot of times people don't exactly know what's going on and what to do. But the main important thing is we pretty much just have to stay the course and hope that everything turns out all right. And if the past results are anything to go by, things will be all right eventually.